Joining us now to discuss is Max Layton. He's Citi's global head of commodities research. Yeah, Max, what do you make of the pullback? Does it make sense to you?
I had thought we would be a bit stronger today. I mean, over the weekend, some of the betting markets were showing a rising possibility of the Strait of Hormuz being affected. And yeah, I would have thought it would have been a bit stronger this morning. But clearly there was a lot of short covering, a lot of call buying on Friday, and no follow through with actual long positions today.
Is the Strait of Hormuz sort of the key here in terms of monitoring whether the conflict has extended beyond what is the current back and forth? And would that have a significant impact on the oil market?
It is a key. We don't think, we think it's highly unlikely that Cargo Island will be brought into this. And therefore, Strait of Hormuz is the potentially large oil supply disruption if it does happen. I mean, I'd just like to make the point that there's already a very big risk premium, geopolitical risk premium in the oil market. We estimate it's around $10 to $12 at the moment. And that risk premium's there for a reason. There's been no real oil export or oil production disruption in Iran. And yet the market's trading $10 to $12 higher, and that obviously reflects the potential for there to be a significant, if not, if temporary, disruption to the Strait of Hormuz supply.
What about Iran's own oil production, which doesn't appear to be targeted by Israel at this point, but what is the thinking right now in the market about whether that oil will continue to flow and whether there's enough or the political will, for instance, from Saudi to make it up?
Yeah, I think the broader backdrop that OPEC Plus is moving to return its barrels is really important to help to explain why there hasn't been any follow through in terms of fresh long positions in the market today. Often investors, when they're thinking about putting on a trade, they need not just the short term to be bullish, and there's obviously catalysts for higher prices potentially in the very near term, but they also need the medium to long run outlook to be bullish. And I think just winding back the clock a couple of weeks, many analysts were calling for $50, $40. Our 12-month forecast remains 65 Brent. And we haven't seen anything that will change that medium to long-term outlook, which is still bearish from these prices.
Max, the other thing we keep looking at, and we did this in 19, we did this in 24, the long-term degradation of oil intensity on the economy and as a share of household disposable income. I mean, isn't the bar getting higher and higher over time for oil to truly disrupt markets in general?
Yeah, that it is. I mean, I wouldn't want to play it down too much. This does have the potential to get a lot worse in the very near term, and that's why the risk premium is so big, around 15 to 20% of the total crude oil price. And yes, it's certainly fallen as a share of GDP, oil consumption, and the value of oil consumption, and certainly in the US, which has shifted to a more, dramatically more service economy over the last couple of decades. Having said that, the US directly consumes about $650 billion worth of oil last year, and a 10% move is $60 billion.